what are sort of the attributes of economic moats that you value? And there was a second part to that, which is, do you think about those moats differently in a growing business versus a declining business? And a business that is sort of flattish.
Okay, yeah, that's a good question. I think the evaluation of moats is probably one of the most difficult things. You know, when I talk to Guy, and I remember recently we were talking about some company, and it looked very compelling to me. I told him, how would you compare this to Nestle, for example? And his perspective was there's no comparison because Guy thinks Nestle is bulletproof. It's going to be there forever, and they're going to keep taking more and more share in emerging markets and so on. And or then I asked him, how does this compare to Weetabix, which was a small UK company, made cereal and such. And of course, he's very high on Weetabix. And so moats are extremely important. I think the evaluation of moats is not the easiest thing. It takes time and some, I would say, lattice work type thinking about in many different ways to try to get to a sense of kind of what those moats are, and how enduring they are, and so on. So it's yeah. I mean, I think that the the expanding businesses or the shrinking businesses or the flat businesses, well, you have to look at it in the context of the actual business. I would say this, that other things being equal, uh, you're better off investing in businesses with huge runways ahead of them. I think you're better off investing where you've got. So again, this is a shift I'm going through, and I've been going through for many years, between buying assets cheap versus buying assets that are going to appreciate a lot in the future. You're always better off buying assets that are going to appreciate a lot in the future, and in Munger's words, paying up for them. You'll end up better. And to give you uh, one example, and I think Tom Gaynor used this example recently. He's from Markel, and we talked about the Nifty 50 in 1972, and we talked about how it got decimated. So if you bought the Nifty 50, no, I'm sorry, if you invested $50 in the S&P 500 on the day the Nifty 50 peaked in 1972, that $50 today is worth $2,800. Okay, it's gone up a lot. It's gone up. How much is it? Like almost like what, 5,000, 6,000%. A huge amount of gain in that period of time. Doing nothing, just sitting on the S&P, right? Now, Tom Gaynor says that if you invested $3 in 3 of the Nifty 50, a dollar, he said, let's say you put $1 in each of the Nifty 50, and now you took just 3 out of those dollars, which means 3 of the companies out of the 50. The 3 companies in the $3 you invested, assume 47 went to zero. The 3 companies that were part of the Nifty 50 today are worth more than $2,800. Okay, and this is worth more than $2,800 by buying it at the peak. So you went through all the valleys, you went through the 90% declines, you went through all of that, but because you had a stomach of steel, like Arvind, who eats his oats daily, you just, with strong fortitude, held on to those stocks through 87, through 73, through 74, through all the crashes, through the .com, through the 2008, you held it all with your steel stomach. You had like $3,000. From the $3 became 3,000. Now, I take a little, I take a little, um, uh, I like Tom Gaynor, but I take a little question with his analysis. And the little question I have is that there's a controversy whether Walmart was part of the Nifty 50 or not. And one of the three that he includes is Walmart, right? And according to me, Walmart should not be in the Nifty 50 because in 1972 it was not a blue chip. It was a very small company. But Tom Gaynor's point was that if one of those 50 companies was Walmart and you put $1 into Walmart, you could had a 96% or 94% error rate, means 94% of the portfolio going to zero and still beat the S&P. Okay, and he makes another point. We all know about the salad oil crisis in the 1960s, where Amex got hit a lot, and then Buffett bought Amex when it dropped a lot because of the salad oil crisis, and he put 40% of his fund, and he made a killing. So Tom Gaynor says, let's say you were the schmuck who bought Amex one day before the salad oil crisis hit. Okay, and you put money into Amex in 1962 or 63, whenever that crisis hit, but one day before, peak price. And next day it drops very heavily. And you held from that time in 1962 till today. You did not touch Amex. And of course, Amex, now is at $70 a share. It went down to $10 a share in 2008. It lost a lot of its value in 2008 as well. But he says that if you held on and you compared it to Buffett buying at the 40% discount, and assuming Buffett held till today, and you compared the annualized return that you had versus the annualized return Buffett had, the two are going to look very similar. In fact, the more time that goes on, those returns are going to converge, even though there was a big difference in the buy price. So the lesson in all of these is that if you bought great businesses, and this is why the Nifty 50s and these bubbles get going, because some pundit like me says you buy a great business and it doesn't matter, right? But that's not what I'm saying. So all I'm trying to say is that between buying a cheap business, buying between buying a fair business at a good price or a good business at a fair price, you should always prefer the good business at a fair price. And so this is another lesson that I've been learning over the years, where in 1999, Mohnish was a cheapskate investor. And in 2015, I'm much more uh, tuned to value managements can add, value that good moats can add, value that enduring moats can add. And I think that the subject of figuring out moats is a really tough subject. I mean, we saw with the Nifty 50 in 72 that the Polaroids and Xerox and Kodak didn't make it. I mean, Kodak there was nothing visible at that time that would tell you that there was any chink in their armor. They had patents out the yin yang, they controlled film, they had a monopoly in film. I mean, pretty much they owned the whole market, So same with Xerox, literally they owned that market. And look where we are today. So moats, the nature of capitalism is creative destruction, and that is the best part about capitalism, is creative destruction. So moats it is very difficult to find moats that will not get destroyed over time. It's an exception to find a moat that will not get destroyed. And so the quest is on for enduring moats at great prices, where the rest of humanity doesn't understand that there's a moat.